We're always looking to build the perfect ETF portfolio, and we think we've now come pretty close. While the overall theme is similar to what we've talked about before, the portfolio has gone through a total makeover, and the end result may surprise you. Spoiler, there's no room for Vanguard.
In this video, we're going to share with you the exact portfolio that we're building going forwards. It's designed to be simple, low maintenance, low cost, low tax, and extremely transparent, so we know exactly what we're investing in. Plus, it should be very profitable.
We'll first look at why there's no room for Vanguard, and then go through each ETF in turn, why they're in the portfolio, and their historic returns. Let's check it out. Welcome to moneyunshackled.com, the investing and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
All these ETFs are available on Interactive Investor. We'll put a link down below if you're interested in signing up. No Vanguard. Probably the most surprising part of this ETF portfolio is the absence of any Vanguard ETF. In our mission to simplify the portfolio, drive down taxes, and to ensure wide coverage across market cap size, we have decided to omit Vanguard completely. This is despite Vanguard having some of the lowest cost ETFs available. The main reasons we dropped Vanguard are as follows.
Reason number 1, no synthetic ETFs. Many greedy countries around the world deduct a despicable tax from your dividends called dividend withholding tax. For some countries, but not all, synthetic ETFs allow you to circumvent this tax, giving your returns an immediate boost.
Most importantly, synthetic ETFs manage to avoid US withholding tax, and it wouldn't be an ultimate portfolio without a large allocation to the US. So it's crucial to eliminate this unnecessary drag on performance. This cannot be achieved with Vanguard.
Although these exact ETFs are not in the portfolio, the comparison clearly demonstrates the effect of withholding tax on US stocks. With US stocks typically yielding around 2% and a 15% withholding tax applied on this, using synthetic ETFs should benefit the US holding of a portfolio by 0.3% every year.
Reason number 2, FTSE indexes. Vanguard track FTSE indexes. In this context, FTSE isn't referring to the UK market, but is the name of an index provider for many global indexes. Tracking FTSE indexes isn't a problem per se, but almost all other ETF providers track those from MSCI. Therefore, you have far more choice if you pick just MSCI tracking ETFs, which our ultimate portfolio does.
It's not ideal to build a portfolio mixing index providers because MSCI and FTSE categorize countries differently and also include different market cap sizes. So, by mixing index providers, you can accidentally double up on certain stocks and countries or miss out on others completely. For example, if you chose an MSCI Pacific ETF and a FTSE Emerging Markets ETF, you would have no exposure to South Korea. If you did it the other way around, you would double up on your exposure to South Korea.
Reason number 3, no small caps. Small caps have outperformed larger and mid-sized stocks over the long term. If this trend continues, you will wish that you had allocated more of your portfolio to small caps, but Vanguard do not have a small caps ETF.
Also, MSCI and FTSE have different definitions of what is a small cap and what isn't, so you would duplicate some positions.
Inside the ultimate portfolio. Number 1, Invesco MSCI World ETF. The largest position in the portfolio, making up 64% of the equity, is the Invesco World ETF, which tracks the performance of 23 developed markets, including the UK, Switzerland, France, Canada, and so on. It has a dominant position in the US at around 66% weighting, with the next biggest, Japan, only making up 7.7%.
This might sound like an excessive allocation to the US, particularly if you see slightly lower allocations in other world ETFs, perhaps for Vanguard FTSE All World ETF. This is because this Invesco ETF is just tracking the MSCI developed markets. We will be adding in a dedicated emerging market ETF for that exposure, which will bring these developed allocations down for the portfolio as a whole.
Even then though, you might think that it's still excessive to invest so much into the US. But it just reflects the size of the US stock market relative to the rest of the world. It's the US where you'll find the lion's share of the biggest and best companies in the world. Apple, Microsoft, Google, Coca-Cola, McDonald's, Johnson & Johnson, the list goes on.
So why the Invesco MSCI World ETF? First, it's a synthetic ETF, and so gives us the tax advantages that we already looked at. It does cost quite a chunky 0.19%, but at that price point it's more important to look at the returns you get rather than what you pay. Having said this, it's still among the cheapest MSCI World ETFs and has the best returns over the last 3 years.
Number 2, iShares MSCI World Small Cap ETF. This beauty is going to provide the supercharged small cap growth for the portfolio. We have opted for this ETF to make up 18% of the equity. A lower allocation than the large cap ETF due to the risks, but large enough to have a significant positive effect on overall returns.
Where the MSCI World Index covered 85% of the market cap of developed countries, this World Small Cap Index covers the next 14%, so combined make up 99% of the market cap in each developed country. This index is also dominated by US stocks, making up 56% of the ETF. Japan and the UK come in second and third with weightings of 11.2% and 6.7% respectively.
This iShares ETF is unfortunately physically replicated rather than synthetic, so we will be suffering from US withholding tax, but at the small cap end of the market there is less choice. In fact, there's only one other ETF tracking the MSCI World Small Cap Index, and that costs a fair bit more. The iShares ETF we're investing in costs 0.35%. Nevertheless, despite the hefty fee on the iShares version and the likely withholding taxes dragging on performance, we would expect this ETF to kick ass over the long term.
Number 3, iShares Core MSCI Emerging Markets IMI ETF. Another area we want to get extra exposure to is the emerging markets, particularly China, as we expect these countries to outperform. We've decided for our portfolios to allocate 18% of the equity to this ETF. More emerging markets exposure than what you would get from a bog standard world tracker.
This index is heavily weighted to 4 countries, which make up around 73% of the ETF between them. The largest, China, by itself has a weighting of 37%, and we would expect this to continue increasing proportionally as China's market develops and becomes more accessible.
With the developed markets, we chose to use 2 separate ETFs, one for large caps and one for small caps. We wanted to do the same with the emerging markets for the flexibility, but unfortunately the cost of a small cap emerging market ETF is too expensive, with the cheapest costing 0.55%. Instead, we're investing in a single emerging markets ETF, which covers both large and small caps. The iShares Emerging Markets IMI ETF is awesome and covers 99% of the market cap, which is what the IMI in the name signifies. This ETF costs just 0.18%, which we think is very reasonable considering the stock markets that it gives you access to.
Precious metals. Number 4, iShares Physical Gold ETC, and number 5, iShares Physical Silver ETC. Gold and silver are real money and have a history of protecting a portfolio against economic turmoil, the kind of turmoil that we seem to be experiencing far too often these days.
When world governments print trillions of dollars worth of currency, they are forgetting that fiat currencies like the US dollar, the euro and the British pound are only based on belief. Investors are choosing to protect their wealth from destruction by investing in precious metals like gold and silver. Stocks tend to fall in bad economic times, and precious metals tend to rise, therefore contribute to a well-diversified portfolio.
Both these ETCs are low cost, with the gold one costing just 0.15% and the silver one costing just 0.2%. They provide a cheap way to hold physical gold and silver without having the risk, cost and upheaval of storing it yourself. For this portfolio, we want 10% of the entire portfolio to be allocated to precious metals. And with gold the default choice and with the most demand, we have gone with 7.5% gold and 2.5% silver. We may tweak this percentage over time in line with wider economic factors and trends.
Portfolio overview. This portfolio has been built by us, for us, and if you plan to copy it, you might want to modify it slightly so it meets your needs. Some people might want to add in bonds, for example. Or use these ETFs as a baseline that you build upon, maybe adding areas that you see value in, such as the UK market, oil, renewable energy, or whatever else you're bullish about. Here is what the portfolio looks like. In our portfolios, we also like to hold some peer-to-peer lending and cash.
If you were watching the video and adding up the allocation figures as we went, you might have discovered that they didn't add up to 100%. That was because the equity allocations we gave earlier was just for the equity alone. We have opted to allocate 75% of the overall portfolio to equity, causing the equity allocation to be reduced overall. Hopefully that is clear from this table.
The overall ongoing charges figure comes in at a tidy 0.21%, and the portfolio is as tax efficient as we could reasonably make it. Between the three equity ETFs, we're covering 99% of the developed and emerging markets across large, medium and small cap stocks. We also have some flexibility in how much we allocate to each of these key positions, and crucially, it is an easily maintained portfolio.
Portfolio overview, geographies. Here is the portfolio by region based on the exact allocation we used. As we've already touched upon, it is overwhelmingly weighted towards North America, which is mostly the US, with a little bit of Canada. You'll notice that the UK is relatively small, but as we discussed recently in a dedicated home buyers video linked below, we see no substantial reason to overweight the UK.
If we look at the top 20 by country, it looks as we would expect, perhaps with a little too much Taiwan and Korea. But to avoid overcomplicating the portfolio, it's good enough.
Portfolio overview, sectors. We're not too fussed about the sector breakdown as long as it's widely diversified, and as we have built a world portfolio, we would expect this. Here is the portfolio by sector based on the exact allocation we used. We're big fans of technology, so it's good to see this take up such a prominent position at 20% of the equity allocation. With US tech stocks like Google, Apple and Microsoft so dominant these days, this comes as no surprise.
The energy allocation seems quite low, but this is likely to be due to the time of filming. COVID has caused oil stocks to tank, and we would expect these to grow in relative terms as the economy picks back up. Some people like to hold a substantial property allocation in their portfolios, so with real estate making up just 4% of the equity, if you're one of them, you may want to add in a REIT ETF to increase this.
The portfolio, historic performance. History is a decent indicator of what we can expect in the future, but most of these ETFs only have a few years of history. What we can do instead is look at how the indexes that they're tracking have performed for as long as we can get hold of data, which varies for each index.
The world index has returned 9.7% annually over the last 51 years. Let's hope we can see more of this. The small cap index has returned 9.5% annually over 20 years. This might look lower than the large caps, but if we re-look at the world index over the same 20 years, then that has returned 6.4% annually, so small caps have smashed their larger counterparts over the same time period.
The emerging market index over the same 20 years has returned 9.6%. If these 20-year trends continue, then it supports having larger allocations to small caps and emerging markets as we have done. And finally, gold has returned 5% annually over 42 years, and silver has returned 4.7% annually over 53 years. But at times have decades-long bull markets, which we may be in the middle of right now.
What we're doing now. We both plan to eventually move our ETF positions to this portfolio in its entirety, but this will be done gradually to keep trading fees to a minimum.
Question of the day, what do you think of this portfolio? Let us know down in the comments. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.